Yeah, so my name is Daniel Kitwa. I'll be moderating the session today. An interesting conversation, a masterclass around blended finance. Um, as I chose orange, from what I gathered from my elementary schooling, orange is a blend of red and yellow. So uh, given that we are learning about blended finance and how to mix different strands or types of capital to provide an optimum financing for off-grid energy solutions, I thought orange would be my color of the day. So in terms of agenda, we're going to take you through a bit overview of how the session is going to be. And then I'll quickly pass it to the GreenMarks team, who will provide more details about basically what you're going to do for the next 90 or so minutes, and hopefully it will be a great interactive session. And I'll encourage you, as always, to feel free to provide comments on the chat, questions or feedback. Don't wait until the end of the session. Just as they come in, we'll probably be incorporating them into the discussion. Capital. We know that public capital is limited, but if used intelligently or effectively, it can be used to crowd in more commercial funding that can be used to scale up projects. We're also going to look at how different models have been structured, especially from the GreenMarks team, with using blended capital principles. And these ones are Green for Access, which is a first loss guarantee fund. I think $50 million target, looking to crowd in local financial institutions to invest in off-grid technologies, as well as Green State Africa, which is a private-public partnership model with the Nigerian government to electrify healthcare facilities in Nigeria. The last thing we're going to do, or an objectives we hopefully would like covered, is to go into a deep dive and review how do we design blended structured products, how do we go about fundraising, how do we what are the things, what are the different pieces that we need in this puzzle as we seek to develop blended financing tools. Yeah, so a brief about GreenMarks Capital. Quite an able team that has worked a lot on the interface of consulting, transaction advisory, and fund management. They've done quite some work designing energy financing facilities, working on policy and regulatory frameworks, and also working on building capacity of lenders. And hence, I think their interest around building, blended financing products to crowd in local capital. They've done some work with different parties, partners, DFIs, development financial institutions, foundations, private players around advisory, using data, using analytics, and even supporting business strategy and capital raising. And also they've done a lot on fund management. And I think this is the focus of the next 90 minutes around how to design blended financing using the two case studies that I've just highlighted. So I guess I'll just pass on the mic right now to Cliff to take over from here.
One more slide, Daniel, the team.
Oh yeah, sorry about that. So so basically Cliff is the head of the GreenMarks team, has worked quite extensively within the sustainable energy and investment space, having advised investors, foundations, DFIs, and different players within different technologies such as solar, geothermal, hydro, and biomass, as well as wind across different markets, Europe, America, Asia, and different contexts as well. He has quite developed a keen interest on fast loss facilities and worked with banks in Hungary, Romania, and other places to spur growth of commercial lending. He's also supported with an able team in Africa. Chude Woje, Deputy Director of the Green Street Africa product, which will be the second product we look at during the second half of this session. He brings over 10 years experience across different off-grid power projects and portfolios he has managed was, up to the tune of 1.2 billion. So quite an able, panelist for this session. And lastly but not least, we are having Koya Alaba joining us from Nigeria as well, who leads the G4A fast loss practice within GreenMax. He's worked quite extensively with subsegments such as the ROGEP program, I think, which is a World Bank facility, and also as Intellecap, we are quite honored to to work on that type of project, which spans across 19 markets in Western Central Africa. And he has also worked on other RE and clean tech type investments. So, I believe just by looking at their profiles, we're quite honored to have them to take us through this session. So without further ado, I'll just pass it on to Clifford and to pick it up from here.
Hi, everyone. This is Cliff Aaron from beautiful sunny New York, very early in the morning. And I want to start off with an introduction to blended finance. So thanks to our friends from Convergence, who are the blended finance heroes of the impact investing space, we have this beautiful graphic which shows the purpose of blended finance, which is to leveraging capital from private investors or lenders and commercially oriented development finance institutions into sectors that require high level of risk taking or lower returns in order to make the activity viable. So these are sectors like energy access that we're talking about today, healthcare, education, business startups, SMEs in general, agriculture, all the things that create impacts for the SDGs. So how does it work? We start with concessional capital, which comes from public or philanthropic funders. That capital is used to mobilize market rate capital, which comes from private financiers or some of the more conservative development finance institutions. The concessional capital is put into some kind of structure or transaction that enables the market rate capital to be contributed into that transaction. So we're going to look at two different models today for blended finance structures. So the first is a fund structure, and the second is going to be a transaction structure. So what does concessional capital mean exactly? So as I said, it's public or philanthropic funds that are offered on a non-market rate basis. And the forms of the concession that's being offered, the non-market rate that's being offered, can be several. It can be that they're taking on general risks that nobody else wants to take. So that could be by being inside the structure of a fund on a first loss basis. That means if the fund is risking 100 and the fund loses 20, then the first 20 is being absorbed by the concessional capital. Or they can take specific risks, for example, regulatory risks or exchange rate risks. Or they can offer lower pricing so that the pricing overall blended with the market rate capital is cheap enough to compete in the sector that we're trying to impact. the tenors of the funding can be longer, can be 15 or 20 years instead of 5 to 10 years. The repayment can be non-amortizing, meaning that instead of paying monthly or quarterly or annual payments, they're charging interest only, and the principal is repaid at the end, allowing all the cash flows in the fund to be used towards the impact purpose. Inside the capital structure, the diagram on the left, you'll see that the concessional capital can be deployed either at the bottom of the stack as junior equity or grants. Grants is self-evident. Junior equity, which is always concessional, means that they lose their money before anybody else loses their money, except for the grant money. Grant money is in the first loss position. Then the junior equity loses its money. And then equity. This is private equity, and they're taking risk, but not as much risk as equity would normally take, because grants and junior equity are below them in the stack. So they are allowing an equity investor to come in to fund activities that they normally wouldn't fund because someone else is taking risk ahead of them. Then there's mezzanine and subordinated debt. Mezzanine and subordinated debt can either be market rate or it can be concessional. And then at the top of the stack, there's senior debt.
Or it can be your mom.
So the purpose is to protect the senior investors or to enhance their returns so they're willing to play in the game. It alters the risk-return ratio for private investors because they're getting most of the returns. So it's an acceptable level of return for them. And it can reduce the overall cost of capital to a viable level so that it can be impactful. The example that we'll be discussing today of this model is the Green for Access First Loss Facility. So the second model is where concessional capital is used to de-risk a specific transaction. A transaction here can mean a big infrastructure project like a solar or wind project. It can mean a portfolio of thousands of off-grid installations of solar home systems. Can mean mini grids. It can mean a investment in a specific off-grid enterprise. So private capital is providing an investment or it's providing a loan into this activity to be financed. That activity is either repaying the loan or providing a return to the investors. And there's customers who are providing revenues to the activity that's being financed. So concessional capital can enhance that transaction either at the level of the repayment to the private capital or at the level of the revenues that are going into the activity. And this can be in the form of a physical cash reserve that's drawn upon to cover losses. It can be in the form of a third-party guarantee that comes in if there's a default. It can be in the form of concessional junior debt that, as we saw in the last slide, takes the first loss in a transaction. And this can be provided by donors, by development finance institutions, by philanthropic organizations. And the example that we'll be discussing today in detail is the Green Street Africa Development Company. Next slide, please. So just a quick overview of the mix of concessional capital that's being deployed in the market. Again, thanks to our friends at Convergence who've done this analysis. So as we see on the left, the lion's share of capital is going into either first loss debt or concessional junior equity. And if you see on the right, who's providing it, the preponderance of these funds are coming from bilateral development agencies and philanthropic organizations. Very little is coming from DFIs and private players. So what's the process for designing a blended finance vehicle? So we start on the left with the premise. What's the critical need or gap in financing for a particular market segment? And the guideline here is it has to be really, really compelling. It has to be really, really compelling because there's a limited amount of concessional capital available. And the sources of concessional capital need to be convinced that the need that you've identified is absolutely critical for the market segment that you're targeting. Second, you're going to come up with your solution. What's your conceptual design of the blended finance structure? How is it going to address that critical need or gap? So the watchword here is make sure that it's unique and innovative. Now, I know, you don't always feel like you need to reinvent the wheel, and that's true. But from the point of view of the funders, the concessional funders, they need to be convinced that nobody's done this before, or at least you're taking a tried and true solution from another region or from another segment, market segment, and applying it for the first time here.
Yeah, maybe Clifford, if I can jump in here.
Yeah.
When you mentioned compelling and also the fact that, it has to be unique, does the compelling, does it get mirrored in terms of, even the cost of what is, in the market, in terms of, if the capital that is commercial is too expensive for that space, and also what would that mean in terms of unique? Would that mean in terms, is it not available in that market specifically, or is something that is not accessible?
Yes, but I can tell you from our experience in raising capital for blended finance facilities that you have to be very clear in articulating what is the problem. Is the problem in financing in the energy access space, for example, is the problem that there's not enough local currency financing? Is the problem that there's not enough affordable financing? Is the problem that commercial lenders are not playing in the field? Is the problem that locally owned enterprises can't access that capital? All of those are valid, but you have to be very clear that this is the problem that I'm trying to solve. And that without solving that problem, the activity that you're targeting is not going to be able to flourish. And in terms of being unique and innovative, again, the funders are really going to grill you, and they're going to say, well, how do we know that your solution is actually going to result in lower cost of capital? How are we going to know that your solution is actually going to result in access to capital for enterprises or for consumers that currently don't have access to capital? Number one. And number two, is that solution available somewhere else? Because we as funders, we don't have so much of this concessional capital. If we put it to you here, if we give you this funding, are we doing something that is not only impactful, but that no one else is already doing? Those are the kinds of questions that they're going to ask. At this point in your process, you're also going to be applying for funding and support for the full development of your model, because here you've only come up with your conceptual design. Next, you have to go to prove that this design really is going to work. So you're going to do a detailed market assessment involving a very large sampling of stakeholders and test the design concept. And my watchword here is listen to the market. I can tell you from our experience that we've come up with solutions in phase 2, and then we've seen that those solutions need to be substantially tweaked because the stakeholders and the beneficiaries that we're trying to target tell us something a little bit different than what we came in with as preconceived notions. The next stage is the full design. And here you have to do your design based on real data taken from the customers, stakeholders, and beneficiaries that you've done your market assessment with. But more so, you have to do it based on real negotiations to enter into agreements with those stakeholders, with partners, real customer agreements to make sure that your solution is going to work. And our watchword here is to go slow and to get it right, because truly, from our experience, it's only when you engage with your stakeholders and you try to negotiate an agreement do you see if your funding model is really going to work in the marketplace. And then finally, partnerships. You've negotiated agreements, now you have to execute them with all the key participants in your scheme to demonstrate that this is real, so that when you go to market, when you go for funding, you have a fully and well-packaged deal that you're presenting to funders. And that's, all of this is a lot. The timetable for developing a blended finance vehicle is not weeks, it's not months, it's years. The two vehicles that we'll discuss today, G4A and Green Street Africa, have taken us 2 to 3 years to develop. So it's a long process to get this right. What are the key metrics that funders are going to be looking at? Impacts on in the energy access space, how many new connections, what employment and economic development impacts, how are you going to develop productive uses of energy, and what are your environmental impacts? You have to make these impacts quantifiable and believable. They can't just be picked out of the air. And the second key metric is leverage. You're asking for concessional capital to leverage in private capital. And the sources of concessional capital want to see that their leverage is big. At minimum, there has to be a ratio of 10 to 1. So 10 times leveraging in of private capital. And sometimes they're looking for as much as 50 times, particularly if you're looking for grant money, you have to leverage 50 to 100 times in order to convince the funder that they should participate. So quickly, who are the names? Who are the main providers of this concessional capital? So bilateral and multi-donor development agencies. This chart shows not the dollar amounts, but the number of transactions. Again, thanks to convergence. These are actually numbers as recent as 2020. So covering the period 2014 to 2020. We see USAID, Guarantco, the Green Climate Fund, DFID and CETA, the main donors, DFIs, IFC, FMO, EIB and Proparco, the commercial investors, banks like Standard Charter and Societe Generale, impact investors, Kenyarth, Calvert, Axion, Oiko Credit, and philanthropy, Shell Foundation, Rockefeller, Gates Foundation, all the usual names that you'd expect. Okay, so that's our introduction. Next, we're gonna leap into the first of our two vehicles, the Green for Access First Loss Facility. Before we do that, if there's any urgent question or clarification, we can take one or two quick questions here. Okay, so let's jump into G4A. Great, so going back to our process slide, let's start with, what's the premise for the Green for Access First Loss Facility? What's the process we went through to determine that this is an enterprise that we should pursue? So we came up with 5 premises to back this idea. The first is mainstreaming of energy access finance. So, there's a huge amount of annual investment needed to meet SDG 7, which is universal energy access by 2030. By different estimates, $18 to $33 billion annually needs to be invested. And currently there's less than 2 billion annually. So how are we going to scale up to get there? And we believe that you can't scale up for off-grid financing at this level unless you mainstream energy access finance with local commercial banks, with local financial institutions. Now, we know that commercial banks are inherently conservative creatures, and they require credit support and technical assistance in order to get into any new business activity, any new lending activity that they consider to be high risk. And certainly energy access is considered that way. We also know that existing instruments to help FIs lend in the energy access space have had mixed results. Things like pari passu guarantees are not strong enough, and credit lines aren't addressing the problem of banks' perceived level of risk. So GreenMax has used a first loss cash reserve product to successfully partner with banks to scale up sustainable energy finance in other emerging markets. So we believe that we understand how to leverage in commercial banks to mainstream energy access finance. The second premise is local currency finance. So currency volatility is obviously a big challenge for off-grid companies because they're earning their revenues in local currency, but the lion's share of capital that's been flowing into the space has come from international sources and has been in hard currency. And we think that local lenders, FIs, and MFIs are by far best suited to provide local currency finance. Third premise, the need for off-balance sheet finance. So the pay-go solar companies in the off-grid space are relying on originating finance directly to their customers. And this places a huge burden on their balance sheet and constrains the growth of the sector. And we believe that local FIs and MFIs can replace that function. They can provide direct consumer loans to the customers of pay-go solar companies. So pay-go solar companies can use their balance sheet to expand their business in other ways. Fourth premise, there's virtually no capital flowing to African energy access entrepreneurs. 90% or more of financing to the off-grid space has gone to international companies. Well, this is not only inequitable, it's also unsustainable, because without having the boots on the ground, without having entrepreneurs that have ownership in these enterprises, they're not going to be sustainable. And we believe that local financial institutions are the most likely source of capital for indigenous entrepreneurs. And our fifth premise, leveraging first loss capital. As we look at the energy access financing that's occurred over the last decade, we see that almost all transactions have needed some kind of first loss cushion, that the DFIs and donors that have provided most of the capital in the space need to be protected from loss by philanthropic funds. And we believe this is going to remain so as the business expands to more frontier country markets, as the business expands from household solar systems to agricultural productive uses, and as we try to finance more and more mini grids. And we look and we see there's a limited amount of philanthropic funding available to take that first loss. So there's a real need to leverage on that available philanthropic funding by creating a structure that brings private capital into first loss facilities. So those are the premises behind G4A. Next slide. So how did we address those premises through our conceptual design? And where did we find development funding to take the next step forward? So the purpose is to provide a stronger than usual credit enhancement and technical assistance to financial institutions and microfinance institutions to encourage increased local currency lending to energy access enterprises and their customers. So we design a risk mitigation product that provides better protection against loss than the pari passu third-party guarantees that are currently offered on the market. So we provide first loss protection for up to 20% of losses across a portfolio of loans in the energy access sector. So that means that we assume the obligation to bear repayment of 100% of the first up to 20% of loss in the loan portfolio. So this is a much bigger protection than pari passu, which is 50% of all loss. So in other words, if you have 100 at risk and you lose 20, G4A covers 100% of that, all 20. A pari passu guarantee would only cover 50% of that, or only 10. And our mechanism for this first loss facility is a physical cash deposit, a cash deposit fund, which we physically domicile at our partner FI or MFI so that it's available to draw on to cover portfolio losses up to the amount of the cash deposit fund. And Koye will review that in more detail. And where do we get development funding? We made an application to the Partnership for Green Growth, P4G. It took about 6 months to go through that process, and we got an award of roughly about $100,000, which funded the design, detailed market assessment, detailed design leading to the launch of the facility. Okay, Koye, I'm gonna turn things over to you.
Maybe before Koye comes in, I think there's a question around what are your views around attracting finance to last mile, small players who tend to be, deep in rural areas but have trouble getting cash. I think these are the mostly local distributors, and maybe you could speak into that. And maybe as you speak to that, maybe give a context of what would be the typical FI that you would partner with. Would it be, a regional bank, a tier 1, tier 2, or what would be the hurdles that the FI would have to tick for them to be part of this partnership?
Great, thanks, Daniel, and thanks, Mark. I see you're asking this question. Great to see you here. So we look at this from the perspective of the structure of G4A, which is working together with banks and microcredit institutions to take the burden of originating finance off of the backs of the off-grid companies themselves. So what we mean by that is that right now, if you are B-Box, you have a balance sheet that allows you to originate loans to your customers. May not be the best strategy, but you have a balance sheet that allows you to do so. If you're a small, locally based last mile distributor, you don't have that balance sheet, and you don't have the working capital available to you to originate those financing terms for your customers. So what we do is we set up relationships with banks like Equity Bank in East Africa, who have an interest in providing direct consumer loans, and they provide that financing to the customers that the LMD, the last mile distributor, brings. So the LMD originates the transaction, but Equity Bank will originate the finance. And therefore, instead of needing, hundreds and hundreds of thousands of dollars of working capital, the LMD needs only tens of thousands of dollars of working capital. Okay, let me turn it over to Koye.
All right. Thank you very much, Cliff, for that introduction. And hi, everyone. My name is Koye Alaba. And for the next 10 minutes, I'll just delve a little bit into the weeds here on how the Green for Access First Loss Facility works. So this slide that I'm currently on, I hope you can all see, shows how the cash deposit facilities, which the G4A would provide to banks, how it would cover losses. And this is a practical example that we've illustrated here, a $10 million loan portfolio, of course, in local currency. And assuming the portfolio is comprised of 5 different loans, $2 million equivalent each, and assuming a maximum coverage of 20% of 10 million is 2 million, and assuming total loss of 25%, which is 2.5 million. As we can see in the diagram, we see that in the first loan with a default of 1 million, the cash deposit facility covers that. And then the next default of 500K is covered also. And the next 250K is also covered. But we see in the fourth loan with a default of 500K, because we've already paid out 1.75 million, there's only 250K left in the cash deposit facility. So only 250 of the 500 default will be paid. So this sort of clearly illustrates how the cash deposit facility would cover defaults on a first loss basis, which is different from pari passu, as Cliff mentioned earlier. So this next slide shows how the cash deposit facilities provided by G4A would support direct lending to customers. G4A would provide 2 types of CDFs, essentially. The first type would support direct lending to customers of PayGo solar companies, while the second type of CDF would support portfolio lending to mini grids. So this slide shows how the CDF would support lending to direct lending to customers of PayGo companies. So we can see here that the PayGo company originates the contract with the consumer, and then the bank will pay the PayGo company for installations from loan proceeds. So the bank will enter into direct loan agreements with each individual consumer. And as we can see below in the yellow box shows the CDF, and the CDF is funded by G4A, and the CDF provides a cover of up to 6 months of arrears on each portfolio loan until it is called up into default. And we refer to those payments that are made to cover arrears. Arrears meaning situations where the borrower has a temporary setback and is unable to make the required debt service payments, which is a temporary setback, not a permanent issue such as default. So we refer to those payments out of the CDF as drawdowns. And the second type of payment that will come out of the CDF is situations where the loan has been called into default. And the CDF would, as we saw in the previous slide, the CDF would cover 100% of principal on each portfolio loan up to the CDF limit of liability. So we refer to those payments as payouts. So 2 types of payments coming out of the CDF, drawdowns and payouts. And to the bottom right, we can see that the bank would have to pay G4A fees for the cash deposit facility. And the bank would also make periodic reports to G4A. And I should also mention that G4A would provide technical assistance to the banks in setting up and in managing the loan portfolios. Right. And I should also mention, so the PAYGO cost, the PAYGO company would be responsible for monitoring the systems and for O&M and also for repossessions of systems. So if a system goes into default, the PAYGO company would be required to pursue repossession and resale of that system that goes into default. And here, this slide shows the second type of CDF that G4A would provide. And the diagram to my right here illustrates the structure of how we would support lending to mini grids. G4A will not underwrite individual mini grid projects on a one-off basis. Rather, the mini grid developers will be required to aggregate their mini grids into portfolios, and the mini grid portfolios would then be owned by an asset co. So the mini grid projects will not be on the balance sheet of the mini grid developers. It would be ring-fenced in a separate company referred to as the asset co, and the local FIs would then lend to the asset co. The CDFs that we would be providing to FIs lending to mini grid portfolios would be in the 7 to 10 year range. For the direct lending to consumers for PAYGO products, the tenure would be between 2 to 3 years. So basically, this is the structure for how we would support mini grid lending. And so the asset co would enter into agreements with the developer and operator in terms of building and operating the mini grids. And the mini grid will be built based on the loan proceeds made to the asset co. And just expanding a bit more on the fees that I mentioned earlier, that the local FIs, the partner FIs would pay to G4A. There would be an annual facility fee in the 1 to 2% range on the balance of the cash deposit facility sitting in the bank annually. So for instance, if the bank has a $1 million cash deposit sitting with them, they would pay 1% on that 1 million. And as the CDF size reduces, as the loans get amortized, the fee would also reduce. Also, the CDFs will be placed in an interest-bearing account, USD dollar account. So in order to hedge against FX risks, we will keep the cash deposits in USD until there is a need to make payments. So if there's a need for drawdown, then the USD would be converted to local currency. For instance, if it's cash deposit facility in Kenya, then dollars will be converted to shillings. And so we would also get interest payments on drawdowns for the drawdowns that are paid out to cover for arrears for up to 6 months. And also on payouts, which are payments to cover for defaults, there would be a one-time charge on each payout that the facility would make. So those are different fees that would keep the fund sustainable. And also the last bullet there refers to, so we've we envisage that there will be two types of drawdowns. There will be drawdowns that will be repaid within 6 months. As I described earlier, due to temporary setbacks, the borrower was missed probably a few months of payments, and within 6 months, they are able to get back on track. However, there is a second scenario where the borrower might not be able to pay those missed payments immediately, and so the loan gets a bit restructured, and the tenor of the loan is elongated such that the arrears don't get repaid until towards the maturity of the loan. So we would also obtain some revenue and some interest on that carryover. So what's the process for establishing a CDF? So when a bank indicates interest to open an energy access portfolio backed by energy access loan portfolio backed by G4A, we would then enter into an MOU with the bank, and we've done this already with about 4 banks, as I will still mention in subsequent slides. So we enter into an MOU sort of covering the setup period, and the MOU allows us to engage in conversations and discussions with the banks. And the next step then entails us sort of facilitating partnership between the bank and the pay-go company or the off-grid enterprise. And then we would then sign term sheets and negotiate and sign term sheets with the bank, covering the pricing, the fees that I mentioned earlier, and what the maximum coverage level will be, and what would be the portfolio composition and size. And then we will carry out due diligence on the bank, on the risk management system and credit policy of the banks. And subsequently, we would prepare a technical assistance plan that is tailored to meet the specific needs of the banks based on the results of the due diligence and the review that we've carried out on the bank. And lastly, we would then sign a cash deposit agreement and a technical assistance agreement with the bank. And from then on, we would begin to place the cash facility with the bank. So what's the structure of G4A, the capital structure? This slide shows how we intend to blend different types of capital, as Cliff has been describing. So, and of course, this is very indicative. We have analyzed different other scenarios, but this current structure here is based on our ongoing fundraising conversations. And so we envisage that G4A will be comprised of 3 capital tiers, made up of senior debt, concessional junior debt, and grants. The senior debt will be provided by DFIs and private impact investors, and the concessional debt would be provided by the philanthropic and public funds, and grants will be provided by donors. The senior debt will have 4% per annum interest rate, while the concessional junior debt would have a 2% interest rate. The yield on the junior debt is lower than that of the senior debt, because even though they're taking on more risk than the senior debt, theoretically, we envisage that the junior debt will be provided by funders that are high impact and that are more concerned about capital preservation. And also due to the fact that they would be covered by CEDA guarantee, we expect that they will accept concessional terms as a result of those. And also because the grant, the 10 million portion of provided by donors, grant provided by donors, will also provide a cushion to the junior debt provider. So the CEDA guarantee that I just mentioned wasn't actually part of our initial concept, but as we began fundraising, CEDA showed very strong interest in supporting the facility by providing up to 80% guarantee on the middle tranche, which is the junior debt. And I should also mention that initially we had envisaged or we had conceptualized that the middle stack would be equity, but as we began fundraising, we realized that the returns that are generated by the fund, due to the nature of the fund being a first loss fund, wouldn't be attractive enough for equity investors. So so we've had to replace that with a junior debt piece. And I should also mention that G4A would be managed by GreenMax, and there would be a 2% management fee paid out annually to the fund manager, being GreenMax. And so this slide shows some of our financial analysis results. We have prepared a very detailed model. We've carried out detailed financial analysis of the facility, and we've modeled about 100, simulated about 100 cash deposit facilities across 10 different currencies, across the 15 countries that we're targeting. And we found in our results that on a pre-tax basis, the senior debt lender, the senior lender would get a return of about 4.5, while the junior lender would get returns of 2.4%. And of course, that's different from the interest rate, because these lenders are also going to be entitled to residual cash. So if there was no residual cash, the senior lender would have a return of 4%, which is the interest rate. But because of the residual cash, there would be a top up on top of the P&I payments. And this returns are a bit modest because, as I mentioned previously, due to the first loss nature of the fund, and there are constraints in how much fees we can charge to the FIs to keep them interested. So the chart on the bottom right shows the cash flow waterfall, and it depicts clearly that the senior lender would always receive payments ahead of the junior lender. And it also shows the distribution of the residual cash. And the residual cash simply means cash that is left after we have made full repayment of the senior and the junior debt principal and interest payments. So based on our assumption that the junior lender would be most concerned about capital preservation and they would be more interested in high impact, we have structured the distribution of the residual cash such that 50% will flow to the senior lender, 30% to the junior lender, and then the remaining 20% surplus would flow to the fund manager. And still on the results, this slide shows the impact that we expect to achieve with the $50 million facility. Based on our analysis, we expect to catalyze about $950 million equivalent local currency loans, energy access loans provided by local banks, local financial institutions in sub-Saharan Africa over the 12-year life of the facility. And this is possible because we intend to roll over and redeploy funds. So as funds get returned back to G4A from the CDFs, we would then redeploy it back into new cash deposit facilities, either with the same banks or with new banks. So the redeploying of the capital over and over, we expect that we'll be able to roll over capital about 3 times over the 12-year life of the fund. And so that enables us to achieve much more impact. And I should also mention, so something that I didn't mention on the previous slide was that the reason why, if you notice from this slide that the principal payments to the senior lender and the junior lender would be balloon payments. So meaning the principal would not amortize over time. It would rather be paid as a one-time payment at maturity, similar to like a bond type of payment. So, and we have structured it that way such that we have enough capital sitting in the G4A account so that we can keep redeploying the capital over the entire life of the fund. Otherwise,
Koye, I'm going to have to interrupt you because we're running way behind time. So could you please just wrap it up and we'll go to Green Street, okay?
Okay, all right. I didn't realize I was taking all the time. Thanks for that, Cliff. So yeah, so this shows the leverage ratio being 19.1%, 19.1. And in terms of number of systems that can be installed from the 950 million catalyzed, we've estimated about 2.15 million off-grid energy systems with a total capacity of 187 megawatts. And lastly, just to talk on the pilot portfolios that we've put together, due to the long time it takes to reach financial close, we have started to organize several pilot cash deposit facilities, about 5 of them, 4 with local banks and 1 with an MFI in Malawi. There are 2 of the pilots with FCMB and Sterling Bank in Nigeria, and the other 2 are with Equity Bank in Tanzania and Uganda. And 3 of these pilots are focused on productive use of energy, solar water pumps and refrigeration, while the Nigeria pilots are focused mainly on solar home systems for households and businesses, and 25% of that goes to healthcare solar. And these are being designed as standalone, such that investors can choose to invest in either one of the CDFs, and then it will be rolled up into the larger facility when we reach first close. And in total, the funding need for the pilots are about 3.5 million for the cash deposit facilities. So so that's it. Thank you very much for listening, and we'll be happy to take questions after. Thank you.
So Daniel, you know, we have only 20 minutes left. Obviously, we ran well over what we anticipated. So we have a choice. We either open for questions on G4A, or we go straight into Green Street Africa. What should we do?
Maybe Cliff, you can answer the question around, as Judy sets up. I think there was a question around how COVID has impacted the desire or the lack of it for guarantees. Maybe you can speak from the supply side and the demand side of capital.
Right. So from the supply side of available funding for the G4A instrument, I'd say there's been an increase in interest from the donor community due to COVID. From the perspective of, are we seeing higher rates of default in the portfolios that we would be guaranteeing? I can't really answer that today. We have a survey of off-grid companies ongoing right now. The initial results seem to indicate that default rates haven't changed very much, but we won't really know that for sure for another couple of weeks or a month.
Okay, hi everyone. Thanks again to Suncorp for this. Yeah, thanks again Suncorp for this. So I'll be talking about Green Street Africa, our model for distributed power for public buildings, and let's get right to it. So, what is Green Street Africa? Green Street Africa is an initiative, or we could say program, which aims or provides clean, reliable energy access for African healthcare facilities. And but I should say it does extend beyond healthcare. Actually, it's an instrument which is deployable to any category of public infrastructure. It is innovative, it is replicable, and it's deployed in partnership with local public agencies in a PPP structure. And Green Street Africa uses guarantee mechanisms to unlock private local currency investment. Remember, Cliff talked about currency volatility. So we have a way around this. Now, let's take a look at the instrument notes. So Green Street Africa establishes PPPs in African countries to identify, develop, and bundle distributed energy projects to be tendered to IPPs or ESCOs. Now, I should give you a bit of background on Green Street Africa, right? Green Street Africa was not always structured or designed as a local currency funding of an infrastructure financing initiative. When we started Green Street Africa, it was supposed to be funded using a US bond issue wrapped by an opaque, now DFC anyway, guarantee product. Well, after some refinement of the initiative, we actually got to, of course, to a stage where the realities of the sub-Saharan Africa, where Green Street, which market Green Street targets, the realities of sub-Saharan African currencies necessitated the use of or the adjustment of Green Street for local currency financing. And that's why you see the second point on the instrument notes, which mentions that Green Street includes prearranged local currency debt packages for the winning service provider, be it an IPP or an ESCO. At this point, I should mention the intervention, or shall I say, the participation of the Global Climate Lab, Global Lab for Climate Finance. I hope I got that syntax correctly. So the Green Street program was one of 8 successful energy access and financing initiatives in 2020, and was sort of incubated by the lab for a period of around 9 months in 2020, during which it was refined, and the comments and the inputs from various stakeholders taken into consideration to bring the product or the program to a stage where it's ready for market, currently being implemented, and also has been endorsed by the lab. So The funding, or shall I say the financing, which Green Street leverages, combines credit and payment guarantees, and that's of course guarantees to for the debt product and the liquidity backstop for the revenues, which the winning bidder will be invoicing to the public health facility, which acts as the off-taker. So to the left on the screen, you'll see the Green Street Africa pilot schematic, and the pilot is actually being implemented in Nigeria. I'll go into a little more detail as we proceed in this presentation, in this discussion. But at the onset, I'll just go ahead to say you can see the PPP structure with the REA. You can see the funding structure. You can see the liquidity backstop, and you can see how the individual projects are aggregated into a pool or a portfolio of projects for which the financing is delivered. Again, Green Street Africa provides clean, reliable energy access in partnership with local public agencies. I can skip this because I think we've discussed this before. So Green Street is a super ESCO. It's a super ESCO structure which prepares public sector energy services projects for implementation by private companies. Very importantly here, right? We're actually using private companies with using the portfolios to be tendered to private companies with competence in both construction and long-term operations and maintenance of the funded assets. Okay, so we're now delving deeper into the pilot, right? And first of all, we'll talk about the PPP relationship. Now, this is actually a first step and a key step in implementing the Green Street model. First of all, a suitable partner has got to be identified by or shall I say in any market into which the Green Street program is being introduced, right? In our case, we selected the Rural Electrification Agency through its implementing partner, which is the REF in Nigeria. And of course, the REA has a mandate to electrify, to provide electricity access to unserved and underserved areas of people in Nigeria. And because of the realities of the very real challenges of electricity in Nigeria, well, a whole lot of Nigeria is actually underserved. So for the pilot, again, this PPP, which is actually, like I mentioned, formed with the REA, will identify somewhere in the range of 5 to 10 federally owned hospitals. They're called tertiary healthcare facilities in Nigeria. That's the highest level, the highest tier in healthcare facilities in Nigeria. They are tertiary, secondary, and then primary. So with the tertiary at the top, and we of course selected this because it presents the most it presents the best opportunity in terms of a portfolio to actually implement the Green Street model. So the PPP will undertake all of the project development activities. So we're talking about whether it's feasibility studies, whether it's the regulatory and permitting, technical assessments, all of that will be undertaken by the PPP. And in undertaking that, the PPP will actually prepare the project fully for financing. And the subsequent part of the project development is actually what we call financial development. And during that financial development part of the project, overall project development, the bond issue will be done and a fully prepared project will be tendered, will put up for tender to competent construction and O&M companies. And what they will have, what they will be looking to purchase the rights to is all of the project, all of the project documents and the project itself, and also financing, which will be already be raised through, or will already be committed through the InfraCredit bond issuance. So yeah, so I've already mentioned that the projects will be bundled into a portfolio, right? Because we need to achieve critical mass. And one of the key reasons for a portfolio, I should mention, is that we need to achieve critical mass, right? It needs to be a certain number, minimum number of facilities, which will be, which will actually be of a size which the lender or the bond underwriter, InfraCredit in this case, would be able to raise funding for. So let's segue immediately to the financing partnership. And our financing partner, as already mentioned, is InfraCredit, who will be underwriting the local currency bond to fund the debt portion of the construction cost. Now, what this does is this bond issued, right, will be wrapped by InfraCredit's own guarantee, right, and will of course take on the credit rating of InfraCredit. InfraCredit is AAA, is a AAA rated agency, right? So that's what that will do. And so it's envisioned that the in local currency, the funding requirement will be somewhere in the range of it's here in USD, but it will be funded in local currency. So it's between $15 million to $20 million. And this is going to be long-term funding for the range of 15 to 30 years with typical bond interest rates, such as we've seen in the typical coupon rates, such as we've seen in the market, and which InfraCredit has already implemented previously. So, as mentioned previously, we're talking now about the portfolio. The portfolio will comprise between 5 to 10 federally owned hospitals, to be owned by the portfolio, of course, of distributed generation assets will be owned by the winning SPV. I should mention at this point that it's not just a portfolio of distributed generation assets, but solar hybrid clean energy assets. That's what will be deployed for each site in the portfolio. Now, we already know that some of these sites, some of these healthcare facilities already have they already have existing diesel gensets, and they already have budget line items going to from the overseeing ministry, which is the Federal Ministry of Health, going to pay for these electricity line items, including the one to the polluting, dirty diesel gensets. So what will happen in this case is that there will be a reallocation of this already existing electricity cost line item. There will be a reallocation of this to pay the invoices from the issued by the Green Street facilities. And of course, this is going to achieve cost savings and also provide reliable long-term power for all of these healthcare facilities, which of course is a dire need. And to ensure that this, the invoices are always paid, it is intended that the Federal Ministry of Health will commit. Again, I mentioned that the portion of the budget already previously committed to pay for electricity, whether it's a mix of grid and dirty diesel, it will commit that line item to pay for the electricity provided by Green Street. So, so how does this all work? In terms, are we talking about guarantees, as in how will the guarantee structure work? Well, as I already mentioned, the bond issue is going to be guaranteed by InfraCredit, which is a AAA rated credit agency, and so the bonds will have the same rating as InfraCredit. So that's the credit guarantee on the debt side. Now on the payment side, of course, there's envisaged another guarantee, which is a DFI funded liquidity backstop to guarantee, or shall I say, to protect against any payment defaults, any potential payment defaults. And we've actually currently designed it to be a $21 million cash reserve, which we're collaborating currently with the UNDP on to access a grant facility which will fund this cash liquidity backstop. So I'll move on quickly to the financial and operational sustainability. So Green Street, when the tender is done, and when the tender is done, and the winning IPP or ESCO takes ownership of the SPV which owns the Green Street portfolio, it will pay to Green Street Nigeria a fee, right? And that fee will, of course, ensure that Green Street recovers all of the portfolio's development costs, and that allows Green Street to recycle those recovered costs into the subsequent portfolio to be developed. Now that ensures sustainability, and I should mention, in terms of technical and operational sustainability, the IPP or ESCO that will construct the assets will also be responsible for their operation and maintenance. So Cliff talked previously about leverage, and you see that in this case here, we're looking at a 12x leverage of the grant monies to the actual financing raised through the bonds, and of course by the second portfolio, the cost paid by the winning ESCO or IPP is invested to catalyze portfolio 2, and by the subsequent portfolios beyond the second portfolio, then there's a potential for impact investors to begin to invest in project development, which will actually be paid out or capitalized as part of the bond issue and paid out to them at the end of the project, at financial close, I should say. Economies of scale. So yeah, we're almost closing. So once the pilot is developed in a specific country or market segment, the setup costs for other portfolios will be far reduced, because there are a lot of development activities which are simply not repeated as they've already been done initially, right? So that's one of the many areas where Green Street differs from other models and is sustainable. And of course, we need to talk about the very real impacts of Green Street. Of course, we're talking about improvement in local air quality due to the use of renewable generation methods and displacement of diesel gensets. We're talking about, of course, achieving SDGs 3, 4, 5, 7, and 13 at the minimum through Green Street. And if we put in numbers to this, right, the first portfolio alone is expected to achieve CO2 emissions reductions of at least 14,000 metric tons. So what's Green Street's USP? Our unique value proposition is that Green Street, of course, as I mentioned, as I've mentioned ad nauseum today, it's innovative, it's catalytic, right? We see that in the first portfolio alone, there'll be a 12x leverage. After that, we'll see up to 30x leverage. It is financially sustainable, not just financially sustainable, it is technically sustainable, which differs a lot from all the solutions which are currently in the market, I should say. And it is actionable because it actually draws on the unique combination of Green Street advisors' experience and expertise in developing clean energy projects across various emerging markets in the world. So the partners, okay, I should just very quickly go through the partners to this initiative for Nigeria. The pilot are the REA, InfoCredit, and of course GreenMax. Thank you all for your time, and thank you for listening.
Yeah, maybe the last one, maybe 1 minute is, I think we could speak around the process of getting buy-in from the government, because I believe the process of getting PPPs signed could take more or less more months or even a year. So maybe you could speak into that as we wind up, and maybe after that I'll pass the mic to Cliff just to finish off.
Okay, of course, Daniel. Thanks for that question. Pretty good question. Now, of course, seen as the PPP, the PPP relationship is one of the I'll say one of the pillars of the Green Street program. The first thing to do, like Cliff already mentioned, is to get the premise right. So, first of all, identify a strategic need in terms of financing gap, and then prepare a compelling financing structure or model, which is then put to the agency, to the government agency that the partnership is to be entered into with, and get their buy-in on that structure. It does take a little bit of convincing, but as long as the gap is clearly identified and as long as the product, at least the structure, is pretty well designed, then actually getting the buy-in of the PPP, of any potential PPP partner, would not be the most challenging part of implementing such a structure.
Thank you.
Yeah.
Cliff, maybe you could speak around just where you are and how can people partner with you?
Great. Yeah, thanks, Daniel, and thanks so much to the IntelliCap team and SoundCulp for giving us this opportunity to speak today. If anything that we learned from this is that blended finance facilities are complex, so complex, in fact, that it was foolish to try to describe two of them in an hour and a half. So we wound up, going way over time on G4A and not leaving enough time for Green Street Africa. Both of these facilities, G4A and Green Street Africa, are under fundraising. For Green Street Africa, we've been fortunate that after being incubated by the lab was able to secure for us a huge commitment of pro bono legal services, and through Rockefeller Foundation, we have pro bono technical services provided as well. And that's allowed us to move forward on the implementation of the pilot, but we're still trying to raise the balance of funds needed to implement the pilot project. For G4A, we've been really fortunate that US DFC has championed G4A and is helping us to bring on additional investors, and CETA, as Koye mentioned, providing guarantee cover. So we're deep into fundraising, but simultaneously, we're also looking to form partnerships with more and more FIs and MFIs in our 15 target countries throughout sub-Saharan Africa. And, we'll be glad to hear from people in the industry, from banks, from MFIs. I've posted my email address in the chat, and we hope to hear from you.
Thanks, Clifford. Thanks, Koye. Thanks, Chude. I think this was a very interactive and exciting conversation. We could easily have spoken for another 2 hours on blended instruments. And also good luck to the two funds. I know it's not easy building one, not alone two. So we look forward to speaking further on these discussions on blended instruments. And as always, if you're out there and you want to connect with the IntelliCap team and with GreenMax, we would be happy to facilitate that introduction. So I think thank you for your time, everyone, and